Good afternoon, everyone. Thank you all for joining FSM1 webinar with Manulife Investment Management this afternoon. I'm Rishi here from the FSM1 Investment Marketing team. First of all, in order to have a better audio experience, we would appreciate if you can mute your mic. Also, we will temporarily close the chat room and resume the chat room later during the Q&A session after the presentation. Okay, so if you have any questions, feel free to type them in the chat room during the Q&A session. Throughout the webinar session, if you are experiencing any audio issue, you can try to rejoin the webinar. Alternatively, you can email us at investhelp.my@fundsupermart.com for this recording and we will send it to you. Okay, so with the above few announcement, allow me to introduce our speaker for this afternoon, Mr. Ng Zi Hao. He's the Head Retail Wealth Distribution of Manulife Investment Management, and he has over 20 years of experience in the financial services industry, covering asset management, banking, and life insurance sectors in Malaysia. He holds a Bachelor of Art from UK, and he is a Capital Market Services Representative License Holder and also a Certified Financial Planner. So for today, he will talk about China and REITs. Mr. Ng, over to you.
Okay, hi, thank you everyone. Hi, good afternoon. What is happening in 2020? That we are badly, adversely impacted by COVID-19. I think in technical terms, we are already in technical recessions, but that doesn't mean the economy will not recover. The economy is fragile. But why do I say so? Because this time the economy is because of COVID-19. The government actually turned off the economy activities. So it will be badly impacted in Q2 and even Q3. So let's analyze in this on the screen about, how do we see COVID-19 impacting the world stock market. Over 50 years events, you have got in the table, if you can see, you have got HIV/AIDS, SARS, avian flu, dengue flu, MERS, Ebola, Zika, Ebola, so on and so forth. As you can see, the market actually performed and progressively 3 to 6 months time. And if you look at the chart of this particular market, it went up, down, can be volatile. Some are impacted by virus and diseases, some are not. If you look at the table, let's use SARS as an example. When SARS took place, I know it felt like now, even though I think this is a lot more serious, this is a pandemic worldwide. But if you look at SARS as an example, 1 month later, the market actually performed 8%. 3 months later, it made even better progress, up to 16%. And 6 months later, the market went up by 21%. What I wanted to share with you is very much maybe a China example in COVID-19. It took them a few months, and then the market, sorry, before I go to these slides. Okay, it took them a few months for China to get out from this current virus. And what you can see is we go through 3 phases. We go through 3 phases in this COVID-19 as human behavior. First stage, we are all worried, we are all nervous, so we sell down our assets indiscriminately because it's a little bit of panic. We didn't know what it is. We didn't know what COVID-19 is for the phase 1. In phase 2, normally for human behavior in phase 2, we start to understand what the virus is, we accept it, we learn about it, so it's no longer in fears, but the level of acceptance will gain over time. Then we go into the phase 3. The phase 3 is what I call life goes on. And people realize that, well, we deal with it. We are looking for vaccines. There's still no vaccines. With or without vaccines, or drugs or medications, life goes on, and we still need to find income. And at some point, we will know the market is very cheap, and people are worried about their financial issues. People start realizing the FD rate like now, the fixed deposit rate like now is very low at 2.6% maybe, and life has to go on. So, in all these example, the world pandemics, in all these example, it shows that even the market came down. It is short term, all right? In a period of 3 to 6 months time, the market recover and it gets higher and higher all the way. So you may say COVID-19 is different, but what we can see from China as a real life testimony is China has recovered, and China has came out, for at least for now, successfully combat this COVID for this time. All right, next slide. So for all the friends and investors out there, I want to give you the 1997 Asian financial crisis. If you remember Asian financial crisis, there was a time that bank ran out of liquidity. It was a crisis of currency. Our currency went down. If you want to take a loan from the bank say they may not have enough. Even if you are good customers taking a mortgage, they will give you 50% of the loan, and the interest at very high level. Fixed deposit, at that time was something like 15% and above. So investor think that, what is the point of investing when it's so risky? Businessmen actually say it's quite the end of the world because this time is different. In all financial crises or in all crises like this time, I always hear this word about this time is different. See how this time is different. It's no longer the same. It will not recover so soon. It sounds like the end of the world. Even people were committing suicide because they cannot service their loans. They cannot make a living anymore. However, if you look at this real life example, the market actually has quite a good recovery after the market did and bottom up. All right. So when people investing at a high, of course they lose their investments. They'll be very fed up and they'll be very upset. We will go through the emotions, but the very least is you stay invested, because by staying invested, you ride through the volatility. And what is even better is when you know that it's bottom, you actually enter the market at a very cheap level. We are now trading at something like one of the cheapest range over the last 10 years, exactly now today. So when the market recover, you recover at the same quantum of how the market has corrected. This time for the COVID-19 and the oil price, from the high, actually the market dropped within 21 days. So I expect once the world is in better control of the COVID-19, when the world government start the engines of the economy, you will see a good rebound because it came down very fast in March, within 21 days. We expect a good rebound this time as well. So this is an example of 1997. If I move on to the next slide, please. All right. One of the reasons that even in Malaysia, if you look at the Malaysian stock market, one of the reasons that people gain confidence is because the world actually announced a lot of stimulus package, be it in US, China, ASEAN, all countries. When the G20 get together a few weeks ago, the G20 announced uh, collectively a stimulus package of US 5 trillion. This is number that is unheard of. Even for US Federal Reserve, the stimulus package is 2.3 trillion US dollars. Is unprecedented. Even in the last global financial crisis, they didn't announce as much as this. The last 2008 global financial crisis, you see a bank collapse, you see insurance company closing down, you see a subprime problem, you see the US government launching quantitative easing one, QE2, a series of stimulus package, but not at this amount. This amount is unprecedented, and it's not just US. Is the world. Even in Malaysia, this part of the world, even in Asia, in China, in Japan, you see it, especially in Europe too. So people gain confidence with the monetary and fiscal policy. The government cut our interest rate to almost all-time low. In US, is as good as next to zero. So people like us will realize that your fixed deposit rate will go down. I think when Bank Negara meet at the next meeting, the expectation is for Bank Negara Malaysia to even cut the interest rate by 0.5%, 50 basis point, or maybe another round of cut sometime later on up to 0.75 basis point, 75 basis point, amounting to 0.75%. So your fixed deposit is going to go down by a lot. And I mean a lot. And that is a consensus out there for even a longer time. 3 years, the very least in the expectation. So, FD low at maybe 2%, it will take all of us something like 20 years, double our FD principal. So it will take a very long time for your 100,000 to grow to a 200,000. And as you can see from my 1997 example just now, if you actually picked up at a low, if you actually picked up, the stock market, some good quality stock at a low, there is a good chance that your return will be even more handsome. Because, in all examples, even for the last 10 years, you have bought your stocks in 2019, 2018, 17, 2016. You have bought at actually average price, maybe at a premium. And now you are buying at a great discount. You are buying on market weakness. So it's a lot of difference. So, okay, I need to move on very quickly. Okay, so valuation has emerged because the market has came down by a lot and a lot. So if you look at the price earning ratio, the valuation method, all right, of how we rate a market, whether is it cheap or expensive, if you look at the PE 2020, the price earning ratio for the world equities, for the Asia ex-Japan equities, the Europe equities, the emerging market, US, Hong Kong, China AHS, India equities, Malaysia equities, we are now trading at a very cheap level. Be it price earning, be it price to book ratio, is some unbelievable good valuations that you are picking up. It is way lower than last year, and it is way lower than the price earning 10 years average and the price to book 10 years average. So our recommendations, number one, Asia is trading at very cheap level. We like Hong Kong and China very much. So later on, I'll be speaking on some China funds to you as part of our recommendation. But for this slide, before we move on, is you get a very cheap valuations today. This is almost at the level of the last global financial crisis. So you are getting into the market at something like once in a 10 years cheapest level. All right, next. Okay, so just now I said China is good. It has got out from the COVID-19, but China is, to me, a very long-term story as well. If you look at China today, they are no longer about plantation. They are no longer about, cheap labor manufacturing. Let me show you more about China. All right, China is, world's largest populations. So they have got the biggest consumption story. They are the biggest in the consumer markets. And they are very young. Their median age is only 37 years. So it's not a aging populations as yet. Maybe one fine day they will reach that stage. But at the median age of 37, a lot of people are still spending, buying houses, running business, buying more cars, investing. So in China, you probably see a lot of new economy. It's new China and innovation to me. And if you are buying now, right now, the valuation, as I show you just now in terms of PE, you are probably buying at 10 times. If you are referring to price to book ratio, you are buying at a greater discount as well. So we like the consumptions in China. We like the R&D in China. I will illustrate further. But even if you look at the Fortune 500 companies, go very big companies like Tencent, like AIA is also listed there, Alibaba, some of the banks, Ping An, and also the Hong Kong Stock Exchange. So they are very established in China. So let's move on. So these are the stimulus package from China as well. And if we can move on, more exciting story ahead of you. Even if you compare the valuations versus the other regions, be it US and Europe, down there on your right-hand side, you can see, our price to earnings ratio. China is trading at very cheap level. Price to book ratio, you are referring to 1.1 times. And we are now, referring to China, we are now trading at below the market average. Not just below the market average for the Chinese market versus other region, you are trading at a good discount. So for international investors, now where do they invest in? For me, I will highlight maybe two key type of investor. Those who are very scared, they'll probably go back to US and keep everything in cash first. But for international investors, we are looking at China. And for Manulife, we have got three key investment themes. We like the consumption story, number one. What consumption stories? The people, the populations is huge and they are getting richer and richer. And they are spending a lot. For example, education. The education system in China is far more expensive than what we have here in Malaysia. And we have got listed company in China who is very good at online education. And property management company is part of our consumption upgrade investment team. Number two, we also like their research and development. They are now very good at vaccines. They are good at medicals. They are good at pharmaceuticals. They are good at biotech. Number three, the government is proactively pushing technology, innovations, and frontier. So you are referring to the 5G, you are referring to semiconductors, you are referring to big data analytics and the cloud services. China is very good with all these things. I will show you some examples here. So number one, we like the consumption story. As you can see from the bottom of this particular slide, they have got good disposable income and they buy foods. They consume a lot of food, beverage, clothing, and the parents are very willing to spend on education, things on cultural or even overseas trip, recreations. They are one of the world's most powerful consumer right now. And they spend a lot of healthcare and medical services. So the listed companies which are listed in China are doing well, making good profits. You know, China in the next 3 to 5 years, you know, we see a totally different China than today even. So, you know, if you have bought Alibaba years back, you know, you make a lot of money. If you believe in the founder of Tencent and pick up a few shares from there, you actually make good profit. And likewise, you got the rest of the company like the Pinduoduo, Xingdongfang, and AIA as example. These are all benefiting from the consumer market. The next slide. Okay, in terms of the research and development, I just show you two examples. Number one, examples in the chart. The China oncology market sales. You know, these are referring to the cancers, all right? The markets that they are in. They are growing at 11%, and we expect the Chinese market share by 2025, year 2025, to go up to 21% world's market shares in this segment. And for their pharmaceutical, you know, they introduce drugs a lot faster than before, and they are now leading the world in terms of even drugs innovation. So their compounding growth rate in their pharmaceutical market is also growing rapidly from before to the coming future. So this is another sector that we like and we are buying into this sector. Okay, so using COVID as an example, they have now gotten out from the worst, and they are actually testing out many types of vaccines. So I'm not surprised China may be leading the way in this innovation, in this new biotechnology and healthcare segment that they are in. They are very good at it. Okay, other than the healthcare, we also like the technology, and in this example, is about 5G. And we are not referring to the phones, we are referring to the chips, we are referring to the battery, we are referring to the parts, we are referring to maybe smartphone lens, which the Chinese listed companies are producing for a lot of 5G handsets. So they are the engines of this. So for that, we are also picking out some stocks and shares in these sectors. So if I can move on, you know, if you look at this, be it in TV, clouds, you know, mobile videos, imaging diagnosis, their e-wallets, their AIs, their 5Gs. I think they are way ahead of us, and they are leading the world in a lot of this innovation. Next. This is one of the sectors that we always use as example of what kind of stocks do we really buy. So this is one stock examples. With the amount of populations, parents are willing to spend on online educations, regardless of with or without the COVID. But with this virus going on, the company like this is going to benefit with higher subscriber and higher profitability for company like this. All right. So if I can move on. So the other investment team that I was referring to you just now is what the government's policies are. This is an example of, you know, the Chinese policy says, let's invest in medical devices. So you can see a 14.6% growth in medical devices in China. So if you are familiar with the stocks, like our fund managers on the ground, you know, we go in to the market and pick up the Chinese medical devices companies that is listed, and we know which one benefits from the current and the future expected events, and we benefit from that. So, okay, ladies and gentlemen, I know I'm going quite fast because I have got a lot more to share with you. If you look at this new technology, it's not just AI, robots, they are even going into private sectors, going into the rocket industry. So it's things that moving so fast. It's quite incredible for China. And that's why we like China this time. And it's not just because COVID-19 is behind China, but if you look at all these long-term story, the opportunities and the valuations that is presented to us, it is very exciting. Next. Okay, so to give you a quick summary about China, before I move on, China is, we like the supportive government policy in all the manners, especially financial packages, stimulus package, in the way they want to drive their economy. Number two, very stable growth. They are still growing, with a stable GDP growth. Last year was 6%. This year they'll be impacted, but once the COVID is over, we expect, China is still leading the world in terms of GDP growth and their contribution in GDP. Corporate earnings is something that we like. We see public listed company in China. You see just now, AIA, Tencent, Alibaba, they are making more profits than before. So corporate earnings is something that is good. So we also go into airshares, the domestic China domestic market. We go into that space too. So I show you the three key investment teams as example. We like their consumption, we like their research and development, and we like their technology. Last but not least, we are on the ground. We have a team of fund managers on the ground. One of our fund managers, by the name of KK, he's award-winning fund managers, winning awards for the last many years, year on year. Manulife is winning awards by managing China. So he's a star fund manager. And all right, so this is our actual investment allocation into China right now. Actual. I know you can see we are heavily invested in consumptions, in R&D sector, and government policy driven sector. Next. Okay, so ladies and gentlemen, thanks to FSM who invited you here. We have a chance to share with you. In Manulife, we have got three, all right, China fund. One is Dragon Growth. This fund is more heavily concentrated in China, about 80 to 90% in China. Some are mostly diversified through the H shares. And we have got the China equity. So this one has got exposure to Taiwan and Hong Kong. And we have got another fund by the name of Greater China. So this fund is investing in the world, including something like US for those China listed companies. So we have got these three funds, and you can see the performance of the three funds. They are different, but in certain extent they are highly correlated. So it's a personal preference about which one you want to go into. It's also a personal preference. Get your advisor to advise you which is the one that is more suited in this market. But what I wanted to say is, all the three, what we have seen is March slowdown. Okay, the stock market was slowed down in the month of March, and it has recovered. It has recovered because people start realizing what I say. The stage 3 in human behavior. Life goes on. You know, what comes after volatility is stability. All right. So China market rebound has already started. You know, take opportunity right now before it gets into a better strength. Yeah, let's move on. What else do I like? Um, in Manulife, we run two REITs. I like REITs as well, Asia Pacific REITs and global REITs. Why REITs, the real estate investment trust? Because we like some of these um, global properties. You know, it's a property play. Number one, the yield is higher. The yield versus the dividend stocks, the yield versus bonds, the yield versus your fixed deposit, you know, is a lot higher here. So we are talking about low interest rate. We are talking about REITs being property asset back. It is more defensive in nature. So this is a slide to show you that, you know, bond is giving negative returns. It's negative returns in many developed markets. So bond yield, um, the one in color, you know, you see a lot negative. Um, Negative interest rate environment, people will look for something that is more positive yielding. So the world investors will consider REITs, and you know, monies will be going into REITs. And I say global investors, it doesn't mean people like you and me, but we're referring to government pool of money, pension funds, institutional money, asset manager like us money, insurance money, investments money, hedge funds money, you know, it will go into REITs because it's giving you a lot higher yield than the bonds. The bonds are offering very low yield right now. And next, if I give you a direct comparison, how do you read this? So if you go to Australia, ladies and gentlemen, if you go to Australia and buy a government bonds for 10 years, you get less than 1% return, 0.98. All right. And if you buy an Australian REIT, you get 5.91. So the difference in yield is 4.93. So the dividend alone is 5.91. Okay, I haven't considered the potential for price appreciation and the other source of income, which is the movements of the net asset value. So this is just the differential in yield. So likewise in Hong Kong, you know, if you buy government bonds for 10 years is 0.69% right now. But if you buy an Hong Kong REIT, you get 6.13. So the yield is attractive. Likewise in Singapore, you know, Singapore is a low interest rate environment. The bond yield is 1.48. You know, the REIT is yielding 6.81. So the differential is a lot. And that's why it's an attractive alternative and attractive investment vehicle, you know, for Singapore REITs, for people to consider investing today, more so than the right-hand side. In the right-hand side, it was last year. The yield difference for this year is even more attractive. So we expect the REITs to continue perform. Last year, the performance for REITs is something like in between 15–20% per annum. So we expect a good performance and a good rally in REITs this year too. All right, if I can move on. Okay, this is the same thing about you get a lot of good spread. You know, here you get a lot of good spread, so I can move on. All right, interest rate, as I say, why REITs? You know, Chinese equities is something that I pick because I think it has got good upside and good momentum. But you know, I pick REITs because I know the interest rate cut is still going to happen, and the interest rate is going to stay very low for a very long period of time. So you need high yielding instruments. You know, REITs, the argument is REITs will not perform as well during a high interest rate environment. But you can see from this comparison, yeah, April 2004 and June 2008 is one interest rate hike cycle. So even in interest rate hike cycle, in this example, Australian REITs perform 45% for that three years period. So that is giving you a double-digit returns. Global REITs up by 33%. Singapore REITs up by 57% during that interest rate getting higher cycle. US REITs was performing 50%. So the same example for 2015 to 2019. So REITs perform in a higher interest rate cycle. So in the low interest rate cycle, we expect REITs to even perform better than this because people will be looking for a higher yield. I'm sure all of you will come to a point that we will start grumbling about the low FD rate, and you will say, you know, buy a house, wait for a better opportunity because house will appreciate, the value is there, you know, it's tangible, you know, it can be a legacy, and the rental alone is already so much higher. And this is what we are trying to demonstrate to you about the REITs market. Okay, so global REITs can be very resilient. So how you read this slide, ladies and gentlemen, the ones, the bold one represent REITs performance. So REITs starting in the year of 1990 gradually moved up. It survived during the Asian financial crisis. So it went up even higher. It went through the dot-com crisis. In the last global financial crisis, REITs, because of the black swan, came down in terms of performance. But the moment it rebounded very well. Okay, so this is what we expect to see, because in March, in February, REITs was also sold down, you know, by about 20% or so. So we already started to see a gradual recovery in REITs. But for a long-term play, we expect REITs continue performing like this long-term cycle. So next. So, you know, what kind of REITs? You know, we are buying a lot of new REITs. You know, it is no longer buying, you know, residential condominium. We actually don't like that. We stay out from that very long time ago. We like the data centers, communication towers. We like, you know, what is more COVID-19 proof. And I will show you some pictures afterwards, and you can imagine it even better. For example, this. We actually buy two companies that runs telecommunication towers, like the pictures that you see. And you can see in Malaysia too. So, you know, the REITs company bought the land, built towers, and allowed transmissions of internet, you know, data transmissions. So the usage of your internet increases. You know, they are transmitting it, and they are developing 5G. So this REITs company, you know, people will be paying them rental. So rental will be paid out to you because you are the owner of this REIT after investing into the REIT fund. So you receive the rental and you receive the earnings from this REIT. So the bottom example is about data center. So, you know, there are REITs company build properties to house data center. Cloud computing is not up in the sky. Cloud computing is down on earth in this data center. So these are the good REITs and the more creative REITs that we are excited with. And we are positioned in there. In addition, we buy hospital REITs, buy healthcare REITs, we buy medical centers, we buy storage REITs because with a lot of online shopping now, they need storage and warehouse. Those REITs are available. We are investing in it. So these are our REITs exposure. As fund managers, we are nimble. We get into better REITs that is available in the market. And likewise, it is very cheap now. Okay, healthcare REITs, as I say, This is one example about retirement homes, medical centers in the developed world. All right. So what is our long-term outlook for REITs? The yield, your dividend is going to be very attractive, and REITs is still in great demand, and they are great management, they are good branding and good names, good managements behind those REITs that we are buying. And we see industrial REITs, healthcare REITs, data center REITs, tower REITs to be our favorite. All right. And globally, investors are looking for you because of low interest rate environment. They want higher yield, so money will flow into REITs, and REITs will appreciate in value in that sense and give you the good double-digit profits that was demonstrated last year. So next, so we have got 3 China funds. We have got 2 REITs fund. The 3 China funds are buying into China and with different portfolio. And we have got 2 REITs fund. One is global REIT. So that one bought into US and Europe and Asia Pacific. We have got another one which is only focusing in Asia Pacific REITs. So depending on what you like, you know, in terms of diversification, and they pay dividend in different period. One is semi, we pay twice in a year, semi-annual income distribution. So the global REIT, we pay in May and November. The Asia Pacific REIT, we pay in February and August. So thanks. You know, we are coming to quite the end of the slide. So quoting what Warren Buffett was saying, when people are fearful, it's probably time for you to get into the market. All right. So Warren Buffett said something that, you know, there are times that it's cloudy and the sky is dark out there, but you know, when it pours gold, and you don't take out your small Tupperware to get out during this good returns during the cheap markets timing. You know, you get your big buckets out there with that opportunity. So Peter Lynch say, you know, he has found that when the market is going down and people buy funds wisely, at one point, very soon down the road, you'll be very happy. All right, thank you. With that, can I move on to the next slides? So I just want to give you a summary of what I've just said. You know, we are very well diversified in Manulife. Today, I cover a few. I didn't cover the whole thing, but I just want to summarize in this. Number one, we got a bond fund focusing in Singapore dollar bond fund, all right, or buying into Asian bonds but converted everything in Singapore dollar. And this is bond. If you like bond, or you like your portfolio to consist of bond, don't be so aggressive. We have a bond fund for you, doing well. And that is denominated, can be denominated in SGD, Singapore dollars, all right? And then I didn't cover Manulife Bond Plus. And this is a local bond fund that perform well. If you like diversification into bond, we have got that for you as well. And today, you know, we have spent a lot of time talking about the 2 REITs. And why REITs is because of high interest rate, high yield, and low interest rate in the bank, and low interest rate in bonds. And we also spoke about the 3 China fund. And why do I like China so much? It's because of the technology, the sector, the R&D, the biotech. You know, I can name you over and over again, the consumption story. So with that, I want to thank all of you for dialing in today and listening to me. And I think it's good for us to end this now. And I'm prepared to take any questions. Thank you very much. Yeah, you know, we pay a lot of dividend. If you are invested in our REITs fund, the Asia Pacific REITs or the global REITs, we pay dividend twice in a year. And if you buy into our Manulife Singapore dollar income, which is a bond fund, we also pay dividends every quarter. And if you get into our bond fund, the local bond fund, so you get a lot of dividend throughout the year. All right, in many months you get all the dividends. All right, thank you.
Thank you, Mr. Ng. Ladies and gentlemen, we will now resume back our chat session. So if you have any questions, feel free to type it in the group chat, and we will actually post the questions to Mr. Ng. So, okay, we have a first question here. Okay, overall, REITs market, how many percentage should we see DPU to be cut in this year due to COVID-19, and how fast the market can recover back?
Okay, that's a great question. We have already seen declining DPU up to even 2 or 3 percentage. So the DPU has came down. But I know for you to ask this question, I'm sure you are veteran in this. But what I wanted to also demonstrate to you is the DPU has came down. But because of the market was sold down, all right? So the price of the REITs has also came down. So DPU down, the REITs price came down, is already happening. The market has already priced in and factored in this. That's why the price came down. So just now, the yield that I show you is the effective yield basing on today's market situation. So it is already happening. Thank you for the questions. It has taken place.
REIT is very volatile. When should we exit?
Thanks for the question. It's a good question. I don't think REITs is very volatile. REITs is fairly defensive. And if you look at the volatility of REITs, it is definitely not at the same degree as the equity market. If you compare it versus bond, I will agree with you. It is more volatile than bond, but it is like, if I want to put into a volatility, it is probably one up bonds but one down from equities. So number one, if you say REITs is very volatile, I think it is not. But your questions has some relevance because of the recent market slowdown. You see worldwide, everything was sold down. So you probably experienced a volatile period of almost everything. You see stock market sold down. You see commodity like oil price was sold down. You see bonds were sold down. You see even Bitcoin was sold down. So you see REITs was sold down. If you are referring to that sold down is indiscriminate selling, I think REITs, because of the yield, it's time to accumulate and it's time to buy. And if you ask me when is it to get out, for every investors or for every investment vehicle, my take is always you buy when the valuation is cheap. You buy when the yield is attractive. You buy when the interest rate from the bank is not giving you a meaningful return. And you sell something when it's expensive. You get out of something when it's expensive. So today, to answer your question, even though it's a REIT question, REIT thing is now trading at cheap level because the prices came down. Just like China, I demonstrated to you the PE, the price to book is trading at a cheap level. Likewise, REITs was sold down by 20%, during this recent period. So there's a good potential for recovery. Whatever comes down, you will go up. I hope I answer your question. Thank you.
Okay, we have another question in reference to REIT. So given a lot of rental deferment and forbearance, especially in retail and office space due to work from home, Do you think REITs is currently a good investment asset class?
Okay, that is a very good question, and it's real, it's happening. Okay, we have seen even government having some policy in this aspect. Uh, deferment. I like the word deferment. All right, deferment is not it's not um, it's not cancellation. Uh, it's not zero. Okay, deferment is probably instead of these 3 months, but we give you a moratorium period for the next 6 months, but it's still payable and liable. It's just deferment. That's number one. Number two, there may be some reductions of rental, um, 20%, 30% over a period of time. Uh, but what I need to highlight to you is, these are all moving in tandem with the interest rate market. Um, so let's say uh, today we are talking about Malaysians FD rate at 2.6% and our average yield at maybe 5%, let's say, all right? So when that situations happen, and it may happen, all right, the rental yield, let's say deferment, our dividend are affected, reduction of rental, it may be affected. So let's say the 5% goes down to 4% because of this reason for the time being. But likewise, your FD of 2.6, very soon you will know in next month's Bank Negara meeting or in this year, any part of the world, you will see more interest rate cut. So the 2.6% or the OPR rate will move down in tandem too. So the situation is we still see a good differential in yield. The differential in yield is still a very meaningful differential. So that situations may happen, but we are aware of it. We are aware of the situation. We acknowledge it, and we are still seeing the good differential in terms of the spread, in terms of the yield. So I hope I answered that question too.
Okay, another question. China GDP before COVID-10 pandemic was forecasted to be around 6%. Now it has gone down substantially. How can corporates achieve good earnings within a short time, say for example, 1 to 2 years?
Okay, I think I touched on this just now a little bit that because of COVID, um, all GDPs and economic activities are impacted. And that is what I say, the government got to turn off the engine, turn off, put everyone at home, quarantine, lockdown, and no economic activities. Of course, there's no much consumption, so you don't see a good GDP numbers. But the governments will gradually turn on the economic activities. So you ask the questions about China, but likewise, you can see in the Western world right now, they can't wait to quickly turn on the economy engine. They can't wait, and they just don't seem to have any more patience. So your questions of how do we get corporate earnings and profits over the next 1 to 2 years? First is about going into the market, looking at those fundamentally sound company, those that their orders, their business orders has not come down. They are still receiving good orders, and they are still growing. Example, internet companies. This period, a lot of internet companies, uh, the share price may have came down because of sentiments. But if you look at the business, um, they are not slowing down. Insurance company, as an example, they are not slowing down in their businesses um, in China. So you got to differentiate. There will be some winners and there will be some losers. So even in our fund management, we don't claim to win all the time. But what we will do and what we are doing actively right now is to pick up as many winners as possible. There are winners coming up from this COVID-19. Like right now, we are using this technology platform. We Zoom. Zoom is also listed. Zoom, in my opinion, the share price is it's got bright future. So there will be winners and there will be losers. So it will be our fund management job to differentiate that. But if you ask me in terms of the overall economy, it will be slowed down. You ask the questions of how to accelerate, and that's why the world government wants to accelerate it through their financial stimulus package. So they are announcing trillions and billions of dollars to pump prime the economy. So the government is playing an active role in this. All right. I think
Okay.
I answered the questions. Yeah.
All right. Another question. Comparison between REITs performance between Singapore and Malaysia. Which one do you prefer?
In terms of our real allocation, we prefer Singapore REITs more than Malaysian REITs. We have minimum exposure to Malaysian REITs. We have got huge exposure in Singapore REITs. Singapore REITs market is more matured. It has got more names. In terms of sector, they are more diversified. They have got more um, 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 diversity. They've got more choices. So we see it as a very different market. International investors will look at Singapore as a REIT market, and there are more REIT listed companies. So it's more exciting in Singapore REITs. Um, so, Malaysians, there are some REITs company, but we in our real actions, we are heavily invested in Singapore REITs with minimum exposure to Malaysia. All right.
Okay. We have another question on Hong Kong. How has the unrest in Hong Kong affected REITs in Hong Kong and Asia Pacific, and will the unrest in Hong Kong continue after COVID-19?
Okay, that's a good question. Last year during the unrest, we see the REITs came down, the REITs price came down, affected our REITs performance by as much as maybe 5%. But that was last year, that was last year. The event took place. The price has came down. It was a historical moment. So after the 5% negative performance, we see a 15% negative performance in REITs because of COVID. So all in, your questions is valid. There could be continuous unrest, or people may have pay attention to COVID. But what I wanted to say is, in all your examples, the damage has been done. We have already priced in. People who wanted to sell because of they are worried about REITs, or people has already wanted to people thinking a REITs price should go down because of deferment or reduction in rental. Because of that, the prices came down, and that's why we are now trading at this level, and that's why we are able to get the amount of yield. If you remember, I show you a comparison of REITs yield in 2019 and 2020. It's all because of this reason that we are able to get a higher yield differential this time. So I agree with you. Geopolitical tensions, world event, viruses will definitely impact fund performances. In this case, we are talking to you at the moment where all these things has taken place and we are now trading at a low level. We are not talking to you at a time that this time that we expect more of these impact the price. We have seen price beaten down and a cheap PE and cheap price to book ratio even for REIT.
Okay,
Thank you.
thank you so much, Mr. Ng, for answering the questions from our participants. Ladies and gentlemen, I think we'll end the Q&A session here. So I would like to take this opportunity to thank Mr. Ng as well as Manulife Investment Management for making this webinar possible. So ladies and gentlemen, if you're experiencing audio issue, you can email us at investhelp.my@pansupermart.com for the recording. We will be posting upcoming webinars on our website as well as our Facebook. Please stay tuned for that. So thank you everyone. Stay safe and have a good afternoon.
Thank you.